All right, folks, get ready for something monumental. Congress members are emphatically urging the SEC to send an unmistakable message and take decisive enforcement actions against any illicit manipulative practices in financial markets. Public reports suggest that market manipulation and abusive short selling tactics are taking aim at robust U.S. banks, with short sellers engaging in targeted and abusive trades that are fundamentally divorced from the actual financial health of certain U.S. banks. Hello, everyone. Welcome to Daily Stock Update. If you are new to the channel, be sure to subscribe to the channel and turn on post notifications by hitting the bell so you never miss any of our uploads and also enter our giveaway. But before that, alert, this is not a financial advice video. In a recent communication to Gary Gensler, the head honcho at the SEC, members of Congress highlighted the alarming trend of short sellers zeroing in on financial institutions that play a pivotal role in providing critical financial services to communities. The urgency of the situation demands the SEC to communicate forcefully and take necessary actions against not only market manipulation, but also potential illegal and abusive short selling practices. Yes, we're talking about the stock market here, and the SEC needs to step up its game. First and foremost, there is a crucial need for the SEC to establish a framework capable of reporting real-time data on who is shorting what and on what fundamental basis. Any short position must come with irrefutable proof and stable, core evidence. No more publicly throwing claims out there and shorting a company into the abyss without solid grounds. The SEC needs to look beyond just banking stocks. They've got to broaden their scope. Investigating specific stocks may be time-consuming and slow, but they can start with the low-hanging fruit. Other stocks that have been shorted extensively and are suspected of illegal manipulation activities. The SEC can methodically work its way up from easier cases to the more challenging ones, proving that manipulation is occurring outside the existing market framework. Now, why is investigating banking stocks so tricky? Well, there's this thing called bank secrecy, especially in securities that may not be fundamentally viable for a particular case. Some banks might have substantial exposure on the loan side, potentially facing a 50 to 60% default rate on commercial real estate if they have a portfolio of it. On the flip side, their investment portfolio might show deteriorating fundamentals, with bonds issued in 2021 or 2020 losing value. The complexity of these situations makes it harder to investigate and build a case against short positions, unlike in other companies where positive financial performance, consistent revenue, and transparent SEC filings make it difficult for short sellers to substantiate their claims. Let's shift gears and focus on a more positive note. Instead of dwelling on what hasn't been done, let's explore what could be done, particularly in terms of regulation. Regulation, as crazy as it may sound, has the potential to reshape the market. Just look at the impact of regulations on the crypto side, such as the pursuit of a Bitcoin ETF or Ethereum ETF. The push for regulation in the crypto space has influenced market dynamics significantly. Regulations, therefore, emerge as a pivotal catalyst for potential market shifts. If we desire a more transparent, free, and fair market, it must be accompanied by specific regulations. These regulations, while posing challenges for Wall Street, could prove to be a boon for individual investors, the little guys striving to make their mark in the financial landscape. Friends, that's all we have for you today. What is your opinion about today's video? Get involved and let us know in the comments down below. Thanks for watching.